Okay, hello. Welcome everyone. I can see there's people attending this webinar from various countries across Europe and Switzerland and one or two further afield. Well, listen, thank you all for joining us. I'm obviously joined by Jeff Taylor. My name's Ryan Edward Donaldson, for anyone who doesn't know me already. And today's webinar is going to be focused on the May budget that came out from the Australian government and some of the proposed tax changes that they are planning to bring in the near future. Jeff, if you can just pop to the next slide for me.
Yep, sure.
Okay, fantastic. So the first few slides are just a short introduction from myself and with Jeff. As I said before, for anyone that hasn't been on our webinars or seminars before, Jeff and I have been working extremely closely together now for the best part of, must be 3.5, 4 years. We met coincidentally when I was in Switzerland, and since then we've been helping clients across, well, on my side, I very much help the clients with their financial planning and all different types of structures in Switzerland, Portugal, Spain, France, and mainland Europe. But equally, a lot of my Australian clients have gone back to Australia, where Jeff comes in to help with the Australian tax side, the super planning, the super structures, the income drawdown. And we work hand in hand to assist you as clients from being tax optimized to where you are now, but also tax optimized for where perhaps you'll be in the future upon repatriation.
In terms of my background, I've actually been looking after expats for a long time, 20 years. I've done 75 seminars in 15 countries. Initially, my focus was the Middle East. So the UAE, Saudi, Qatar, and then for a period of time in Asia. But more recently, fortunately, since I met Ryan in Europe, and also some activity in the UK. So I'm a tax specialist. I've got a Master's of International Tax from Sydney University. I'm also an Australian financial planner. So I can't give any financial advice while overseas. That's Ryan's domain, but I could certainly provide tax advice. And what Ryan just said is absolutely key. So after 20 years of looking after expats, the one key thing I say to everyone is tax optimized for where you are, but also with a look over your shoulder to where you're going. And so you've got to look at both. And the longer you're going to be overseas, the more you're going to tax optimize for where you are in the current country. But you've also got to look to the future and where you're going to retire and where you want your assets to be in the future.
Yeah, certainly. You can pop to the next slide for me. Okay, great. And likewise, just a short introduction on my side. So I've worked with Skybound Wealth Management for well, this is actually my 10th year coming up in September. I don't know where that time's went. Although my professional qualifications, I'm Chartered Fellow for CISI, which is the Chartered Institute for Securities Investments in the UK. I would honestly say the UK planning side has only constituted 10% of the advice for myself over the last 9.5 years. Where my passion lies is helping people cross-border planning. So initially that was a lot of British people. It was helping British people who moved to France, who moved to Switzerland, who moved to Spain, who moved to Portugal. But during my travels, I've worked in Belgium, I've worked in France, I was in Switzerland for 5 years. During my travels, I've realised that I was actually picking up a lot more clients and many other nationalities, because equally the same issues that somebody perhaps who's French citizen has is the same as the UK, whereby they're leaving a country which has a different structure, different pension structure, different assets, assurance fees, properties, and they're moving to a country where things change if they're living in Switzerland or they're living in Spain. So it's helping people understand how to restructure their assets to be tax optimized for where they are now. And Jeff, as Jeff pointed out there, also tax optimized for the future as well. The interesting thing was I wasn't speaking to many Australians before I met Jeff, and I don't think that was deliberate. It was just that the element of you can't be a specialist in every country, right? That's not how the world works. I was focused on my nationalities and my mainland Europe. But when I met Jeff, it was a light bulb moment for me when he was explaining how the tax system is effectively inverted from Europe and most of the world. What I mean by that, and I'm sure Jeff will touch on it later in the slides, what I mean by that is effectively, for anyone that has a UK pension or UK assets or French assets or Swiss assets or anything Europe on this call, you'll know that typically your vehicles will grow tax-free most vehicles will accumulate tax-free in pensions and in personal assets, but then when you pull the money out, they'll be taxed on drawdown. So they're taxed on drawdown, not taxed on accumulation. Australia is the complete opposite. Majority of your vehicles in Australia, even a superannuation pension, your investments, they're actually taxed year on year. So every year you make a bit of growth, it pulls back, bit of growth pulls back, but then they're not taxed on drawdown. So you've got these two inverted systems, which I'm sure some of you on the call are already having the light bulb moment that I had, whereby there is very much certain do's you want to do, and the element of maximizing tax-free accumulation and tax-free drawdown if you're going back to Australia, but there's also certain don'ts you don't want to do, whereby you don't want to be taxed twice. And that's the importance of getting your vehicles right. And that all depends on, you know, where you plan to be for the future and what your residence is going to be. Just a little bit about Skybound. Jeff, if you can pop to the next slide for me, please. We are an independent financial planning company. I'll not cover every region on this slide, but it's important you know that we started as a UK-based financial planning company 26 years ago. We've still got offices in London Mayfair, London Bridge, down in Poole and Dorset, and up further north in Sheffield. But since then, we've expanded all over the globe, which you can see all of these areas here. The only thing that's important for everyone on the call to know is that each area we actually operate, we're regulated locally. So for example, if there's some of you on the call right now who are considering your planning in a Swiss environment, the regulation in Switzerland, we carry dual regulation. We have ARIF and FINMA. So it allows us to provide advice on all aspects of Swiss planning, whether it's retail banking, private banking, Swiss platforms, life insurance, pensions, etc., etc. And that's the same for Europe. Europe, we carry the MiFID II regulation, the UK, the FCA, Financial Conduct Authority, the US, the SEC, Middle East, the insurance authorities in ESCA, and so on and so forth. The only reason that's important for you to understand is in order to provide completely accurate cross-border planning, you must have the regulations in each country to provide the local solutions in each country. And that's actually detailed on the next slide, Jeff, I believe, if you pop to the next one. Yes, here's some of the regulations.
Licenses are key.
Here we go. So we very much work hand in hand. Before I pass over to Jeff here, you know, my services are every aspect of financial planning, from lifestyle financial planning, your retirement planning, income drawdown. We have tax specialists in every country we work with to help you with your tax returns and tax drawdown. We do advice from pensions to investments to insurance to banks. We do property developing, litigation, wills, tax specialists in that area as well. On the other side, Jeff's focus is very much on pretty much many of those services, but on an Australian local basis. We have a professional partnership agreement whereby when we are typically servicing clients together, I'm advising on the European side if they're still resident here. And then when they go back to Australia, Jeff's advising on the Australian side. But equally, if you do move back to Australia, it doesn't mean you automatically close the European. And likewise, when you come to Europe, you don't automatically close the Australian. So you tend to find you need that dual advice for prolonged periods of time, if not perpetually, until you pass. So I'm going to hand over to you now, Jeff, to focus on the budget and the updates from the Australian government. And yes, if you need me at all, I'll step in throughout the webinar as normal.
Okay, thanks very much. So I think this is my 16th budget webinar or seminar. And I've seen a lot of changes in that time. So I'm following a sort of a similar format to what I normally do, which is to go through the budget in detail. And also I've included some commentary on tax changes, which is always front of mind. And also an update on tax residence, which is also something that's been in the news in the last 12 months or so. So unlike Skybound, our business agenda is not global, we're local. We're based in Sydney. Most of our clients are on the East Coast. We do have some in Adelaide and Perth, and I just travel around to see my clients wherever they are. So we've been in business now for over 15 years, and we provide a mix of tax and financial planning services. So if we just dive straight into the actual budget itself, before I do that, general advice warning, which is basically to say anything that Ryan and I mentioned today is general in nature. We haven't taken into account your personal circumstances or goals and objectives. So that's what we do if we do proper financial advice. Okay, so the first thing to look at is it's important to know the sequence. So we normally have a budget on the second Tuesday in May. That's the sort of designated day. So you might be wondering how Jim Chalmers ended up doing his third budget, and yet he's only been in Parliament for just under 2 years. And the reason is that the previous government, the Morrison government, decided they wanted to go early to an election. So they had a budget on the 29th of March. They went early on the 21st of May and lost. So we then had a situation where the Parliament started in July and Labor basically did a veto of the budget and then got back to the normal sequence. And I guess really the sort of budget that we're seeing today is the calm after the storm. So it was a very dramatic period of COVID, and that's why the sequence of budgets got out of whack. So when Labor won, they only won 77 of the 151 seats in the House of Representatives. So they had a majority, but not a huge majority. And that's significant in the framing of this budget. So this budget is very much focused on when is the next election going to be, and it must be before the 27th of September 2025. So there could be another budget as per normal in May, or they could go early to an election, which would change when that budget actually occurs. So there's a lot at stake, and that really, it's really the sort of budget where tried not to offend anyone or very few people at all. And so that's really what we've seen in all of the initiatives. The first major initiative really was around cost of living relief. So Jim Chalmers, the Federal Treasurer, was very keen to point out at the start of his budget speech that he was looking at ways to ease the pain of inflation. So inflation has been a phenomenon around the world. In Australia, it peaked, I think, at 9%, and it's back down to about 3.6%, but people are still hurting. So there was an overstimulation during the COVID period, which led to inflation, and we're now trying to get that inflation under control. So the government likes to do as much as they can to try to alleviate the burden of those inflationary pressures. So the stage 3 tax cuts were already in the pipeline and were argued about some months ago. They are now going to happen from the 1 July. And so that's going to put an average of $36 a week into the average pay packet. So that helps to alleviate some of the burden of higher interest rates, which have gone up dramatically in response to the high inflation environment. So if we look at the rest of the types of initiatives, it's a typical Labor budget. Make sure that the pensioners are looked after, give them some cheap medication. Anyone that's on medication doesn't want to be paying too much for it. Student indexation of debt, so the HEC system, I'll go into that in a bit of detail. There's also a Future Made in Australia, which sounds like a big thing, but 22.7 billion over 10 years isn't really a lot. So that's focusing subsidies and loans and money into certain key areas that are pet areas for the government. We've got a cap on international student arrivals, I guess because there's been a lot in the last little while. There's also the whole care economy has been underfunded, underserviced, underpaid. So there's a big focus on that. So one of the newspapers had the headline, "Killing Us with Kindness." So I think that's a bit harsh, and also bung it on the afterpay. So basically, spend now and worry about it later. I think that's probably a little bit unfair. I think it was a pretty balanced budget. And yes, of course, the government is going to be focused on the next election. But overall, I thought it was a fair and good budget. So we need to look at the economic assumptions here, because that 2.75% assumption for inflation is the key to the whole shooting match. Because if the federal government can't get inflation down under 3%, and remembering that the Reserve Bank has a target of 2 to 3%, then we're not going to see a cut in the cash rate. In fact, there was a poll of economists back in January that said the next rate cut was likely to be in September. Now, if you ask most economists, they'd say maybe not at all. And so for Jim Chalmers to say, well, we think there's going to be lower inflation, which would then suggest a rate cut before the end of the year, I think that's probably an optimistic call. But that's what he wants to happen. So if you look at the migration rates, the 528,000, Australia's population went from 26 million to 27 million, I think, in the shortest time possible. But that's because there was a big amount of immigration off the back of probably during COVID, virtually no immigration. We need immigration. It underpins our economy. We also have shortage of workers. I'm actually building a project home at the moment with, a major builder where it looks like it's going to be a 100-week build time frame when they told us it should be 29. So there's a massive shortage of workers, and some of the shortfall will actually be made up through bringing in people from overseas. Many of the people that are working on my project are actually from overseas, and they're doing a great job, but just not enough of them. So these key inflation assumptions really underpin the budget. They really need to see inflation lower to feel as if they've been successful. Now, what they're doing with subsidies, so if you give $300 to every one of 10 million households across Australia, it actually reduces the measured inflation. But then you say to yourself, well, then there's $300 in everyone's pocket to go and spend. So it could actually backfire on the government with all of this extra money, also from tax cuts. But they're hoping that they're going to be able to stage manage the cost of living relief, but also not have inflation spike. If we look at this slide on the right, what it shows is there's certain types of services that are going up at much faster than the CPI. So insurance, health, electricity, which is why the government has targeted electricity for the subsidy, petrol. These are the things that are going up at faster than that, whereas women's clothing, fruit and veg, and various other things are tracking below that average. So it's not as if everything's tracking up at the same level. On the chart on the left, it looks like, oh, we're just almost there, but it's not really that easy. If the economy starts to accelerate from here, which it could, you could have a spike to the upside rather than what looks like a logical trajectory lower. So this is what the government is really concerned about, and they're trying to do everything they can to get inflation lower. I mean, inflation is something we didn't hear about for a long period of time. You know, inflation was back in its box. Then I can remember the inflation of the 80s where it was, 15%. It was off the scale, but that's a different era to what we've experienced with ultra low interest rates and low inflation. So we're just trying to get it back to where it needs to be. This table of truth, this is from Shane Oliver, who's a well-known AMP commentator. So we're looking at a budget surplus instead of a deficit. And so that's actually two surpluses in a row. But then you see deficits running out for the next 4 years. These are not high deficits in the overall scheme of things, given that you're talking about a $700 billion revenue stream for the government. So we're not talking a ridiculous amount of deficit, and also measured against GDP. Australia's GDP is above 2 trillion Aussie dollars. So a deficit of 1 to 1.5% is not ridiculous. But this is what the Australian is talking about. They're saying that we're going to have to pay later, but not really that much. I think that's still responsible budgeting. But having said that, we still have a structural deficit, and I think that's going to persist. Structural deficits where the spending is higher than the income, but where there's a lot of pressure in the economy to spend on, aged care and all sorts of different things, the government would prefer to be on the high side of expenditure and not on the low and paying back debt. So you get these lines that where everything looks magically back to, revenue is going to catch up to spending. But the 16 years that I've been doing these seminars, the blue line has been below the red line, and except for 2. So generally we've been building up debt levels rather than paying off debt, but we started with sort of a virtual zero debt position back in 2006. So it's not actually that dramatic. Our budget position is still, or our debt position is still relatively strong. Once again, a set of lines where it all magically comes back to the line ball by 2034. It never works that way, but that's what they put in their forecasts. So this was part of my analysis. I actually went to drill down because I wanted to see if a lot of people are interested in, where is that debt and how much interest are we actually paying on it? And these are all the T-bonds that the government has issued, and it adds up to about 860 billion. But some genius has gone out there and borrowed money. Imagine if you could borrow money from between 1 and 1.75%, and you could borrow 187 billion of it. Well, that's what they've done. And obviously this is back in the days when there was ultra low interest rates. So we've got 20% of our debt at ultra low rates, which is fantastic. And some of that, goes all the way out to 2032. There's even a bond that runs to 2051 at 1.75%. Happy days. So this is why, Australia's got a AAA rating, and AAA rating has been maintained by the ratings agencies. So we can afford to borrow cheaply. We're talking about 6.7 years of average maturity date, which is fine. But also the actual average rate's only 2.37, which is good. Now, what's missing they don't highlight the fact that the future fund is a big investment fund. So whilst we've got 900 billion of gross debt, we've actually only got 500 billion of net debt. And the delta is partly or mainly the future fund. You look at the future fund, it's done 8.8% compound for the last 10 years, which is 5.5% more than the interest we're paying. So this is where, yes, we may owe 900 billion, but if we've got a future fund that keeps kicking the can with no tax implications because it's the government, sovereign wealth fund keeps going up at, say, 8.8% per annum. So that's a nice little backup. It was originally created to fund pensions for politicians and other government workers that are on defined benefit schemes, but obviously it hasn't, it's been used for wider purposes and it continues to grow in value. So our debt position at 500 billion is like somewhere around the 30 to 35% of GDP, nothing like what it would be for, say, America or other overseas countries where, it could get 100% of GDP or even more. So this is the reason that the government feels that it's still okay to spend, and that's basically what they do. So as I go through these list of winners, there's a lot of winners. So basically, every Australian who earns and pays tax is getting a tax cut. They're also doing things to help pensioners. So a deeming rate is basically saying your deemed rate of interest is only 0.25 on your investment earnings, 2.25 will enhance your benefits. There's also, they're paying super on top of paid parental leave. So you go on leave and you still get your super paid. Medicine's capped at a certain rate, even though the medicines would be worth a lot more than $7.70. Low income renters are getting assistance. Students, so indexation of HECS, which is our student debt system, last year went off the scale with inflation, 7%. The government basically said that's not fair. So they've come up with a different way of calculating HECS, and they've actually backdated to last year. So students will only suffer a 3.2% uplift. So even giving some money back to students. Two of my sons have got HECS debts. One of them's got close to 40,000, so he's very happy with that initiative. And it is really only fair. They've changed the rules so that basically it's only going to be a 3 to 4% uplift in future. Home builders basically are massive winners. There's going to be a lot more places for apprentices. And these at the bottom of the list are really part of the Future Made in Australia. So they've selected certain industries where they're going to be giving subsidies and basically a bit of support. And there's a big document written on it. It's a very fluffy document. 22 billion isn't a lot of money to spend on it, but it's around the political objectives of things like net zero, supporting the net zero transformation, renewable hydrogen, green metals, low carbon liquid fuels, all of those sorts of things. The losers, there's a big fiasco with Pricewaterhouse around tax. Won't go into the detail, but it basically caused the government to say, let's think twice about using consultants. So they're going to reduce their spending on that. Universities are capped on foreign students, probably because that needed to happen. There maybe wasn't enough places for Australian students. And also, I guess the last one there, the NDIS, which is National Disability Insurance Scheme. It's a big name. Started off at 11 billion, on the way to 60 billion. Clearly, there was a lot of rorting of that that's now being brought to heel. They haven't got the rate of increase of that down to the target of 8%, but it's about 9.2. So they've done a lot of things to bring that back under control, which is a good thing because it was headed for a really big number, but now it seems to be under control. So really the whole push of the budget was around supporting Australians that are doing it tough, but basically giving everyone a free kick with energy subsidies. The structural deficit's going to have to wait for another day, as has been the case for the last 15 years. Future Made in Australia, it's going to be a Made in Australia Act. It's sort of doing something along the lines of what the US is doing with the Inflation Reduction Act, but nowhere near the same sort of scale. It's sort of dipping a toe in the water, I think. Maybe we'll hear more of that and it may be expanded in future years. But I guess the key issue is, if we look at Dr. Chalmers, the Treasurer, he's a student of Paul Keating. He did his PhD thesis on Paul Keating, Royal Statesman. I've read some of it. It's very dry reading. But Chalmers would love to be, you know, if he was 25% of what Keating had done over the years, he'd be very impressed. So he hasn't done any Keating-like major changes, but they clearly want to win the next election and be in a position to bring in, you know, so there could be reforms around GST, there could be further superannuation changes. There's a lot of things that arguably need to be done that just didn't get done, probably in the too hard basket this time around. But we could see in future years. Housing is in crisis. It's not going to be an easy situation to solve if you don't have enough workers that are trained. So they will address these things to some extent, but they've got, the main thing is for them to get inflation under control. So the actual tax cuts, so I think the average, or if you earned less than 146,000, you were better off under the revised stage 3 tax cuts, called stage 3 because there was stage 2 and 1 before that. So the Albanese government basically picked up the previous government's changes and dusted them off and decided that they were too generous to high income earners. So they fiddled around with it to make it more attractive. And so you've got a 16% bracket now, whereas it was higher before. So it's given a tax cut to everyone, and I think it's pretty fair. If you're a non-resident, you're going to lose, you miss out on those first 2 brackets. You don't get the 0 and 16. You pay tax at 30%, but only on taxable Australian property income. There's things you can do to minimise that. If you're paying a lot of Australian tax on your properties, you probably should get some tax advice how to minimise that. It's also worth mentioning there, that rate band down the left-hand side for resident taxpayers, you've got to add another 2% for Medicare. Medicare doesn't get you any medical benefits, it's just another tax. That means our top tax rate is 47%. But if you're earning 135,000, your average rate of tax is probably only around 25% average. So it's not too dramatic if you're in that sort of up to 135,000 range. So if we then go into superannuation changes, and these are basically already legislated. So the concessional cap, so this is if you're in Australia and you're paying in with your superannuation guarantee, which is the mandatory contributions, and if your mandatory contributions are only 10,000, you could put in another 20,000 and claim a tax deduction. That 30,000 cap is at the moment 27,500. So as Brian alluded to, we tax contributions on the way in. We tax them while they're there, and under certain conditions, or most conditions, no tax on the other way out. We're on the other side of the world, so I guess we're going to have a different regime. The actual non-concessional, so this is where expats, if they bring back a lot of money, so non-concessionals are not taxed. If you've got a lot of money and you want to ramp up your super quickly, which if you're coming back after a long stint overseas, the 120, which is always 4 times the concessional cap, and you can do 3 years in one go. Forward-looking, so you can basically, if you go into the 2025 tax year, you can put in 25, 26 and 27 years worth of contributions in one go. So we now talk about the things that have been fiddled around with over the years. So there is a cap, you know, there's a transfer balance cap. You can shovel all this money into an accumulation account, but when it comes time to switch over to a pension, you can only do that with a certain amount of money. At the moment, it's 1.9 million, probably going to be indexed to 2 million next year. So that's still a big number. If you were retired with 2 million, you could maybe take 120,000 a year tax-free. Still a fair bit of money, and that's per person. So for a couple, you're talking about 200,000 a year tax-free. There's certain conditions around making additional contributions, concessional contributions. You need to pass this work test that used to apply to non-concessionals as well, but it's been taken away. So there's various restrictions. It's very restrictive, really, compared to what you see in these offshore bonds that Ryan's talking about. So you still got to fit within the rules in order to get that happy retirement scenario of a tax-free income. And the drawdown rates, once you click over to the pension phase, so if you had 2 million in the pension phase and you were 65, you're duty bound to take out 5%, 100,000. And as you get older, you could take out more and more. So the system is designed to force money out of the system, out of this protection of super as you get older. Reality is that as you get older, you don't need as much money. So this is where when people are in their 80s, and if they've got excess money, they generally would take it out of super and then look at estate, look at the succession of where that money's going and what they want their estate to look like. There's a sting in the tail being debated as we speak in Parliament in the last few days. So this is a cap. This is an additional tax on more than 3 million in super. Now you might say to yourself, well, if there's a cap on how much you can take into the pension phase, how do people get to 3 million? Well, because the transfer balance cap's only been around for 3 or 4 years, there's a lot of people with more than 3 million in super now. And so this is a grab for tax, an extra 15%. But the worst thing about it is it's not just 15% on income over and above the base 15%, it's 15% on unrealised capital gains. And that's what's being argued about. So imagine if you had 100,000 of unrealised capital gain in a year, they'd want 15,000 of tax, even though you hadn't sold the asset. And if you then made $100,000 capital loss the next year, you wouldn't get a credit for the tax you've paid. You'd have to wait and use that out of future capital gains. So it goes against basically the overall thrust of the way super works and the way the tax system works. So there's various players, the Greens and the Teals and various other bit players are having their 2 cents worth. So it might get shouted down, it might get changed. So we don't have the legislation across the line, that's still being debated. And I'll definitely tell you about it the next time when it has been legislated. So if we look at tax residence, so this is a slide I've used many times, the rules are still the same. So even though there's proposed changes, the rules are still the same. You can be caught in the Australian tax net under any of these rules. And if you're you could also be dual resident. So you could be tax resident of Australia, but also still tax resident of the country in which you live now. And so then there may be treaty relief, tiebreaker rules, Article 4, all of those things. So what's changed? Finally, we've got a new ruling, which actually dispenses with the 3 previous rulings. And I went through all of these case examples, 1 through 18, and I've actually put in brackets, given that I've read all the cases many times over, I'm familiar with the circumstances. And so what they've done, to their credit, the tax office has gone through and said, okay, we need to reflect every case to some extent in these examples. So you can, if you're concerned about your tax resident status, if you're in that sort of first 2 years overseas and you're not sure whether you've satisfied the requirements, then you should go and look at those examples and see which one looks like it's got your name on it. So the beauty of this is that you don't necessarily need to see a tax professional unless you're concerned, having read those, you can't find one that looks like it fits your situation. The way it was, IT 2650 back in 1991, a very old ruling, I used to present on this and it was very difficult to pick up on all the nuances of how that actually worked. Whereas with 18 examples, you don't really need to go to the actual cases. So I think that's a big step forward. I was very impressed with it. Not so impressed with paragraph 108. So the tax office basically has had it say, well, yes, even if there is a double tax agreement, we're still going to treat you as being tax resident as long as it's not inconsistent with the allocation of rules under the DTA. So that's basically saying, oh, well, we're going to have first grab. But the reality is, Australia signed up to DTAs in 45 different countries. DTA is still going to have the say. So I guess that's just a throwaway line there from the tax office saying they don't necessarily like DTAs. Well, but they're going to have to abide by them. So the key issue that keeps raising its ugly head is this 45-day rule. And I went back and read all of the blurb and all of the commentary on how they got to the 45 days. And I'm not actually convinced they understood, some of the overseas jurisdictions that they referred to, where they basically were talking about a 45-day outbound rule and saying, in Australia's case, we're using a 45-day inbound rule. I don't think they really understood the way the UK rules worked. But the key issue with this is that this isn't legislation. This isn't even near legislation, even though it was announced 3 years ago. I had the opportunity to talk to Fletch Heinemann, who was Cooper Grace Ward partner, who managed to win the case for Harding, which is one of the major cases in the last 4 years. And I asked him about when this legislation was coming, and he said he thought his intel from the Treasury was that there was a lack of drafting resources. So if there's a lack of resources to write the legislation, and it's probably some of the most complex legislation ever, hence you see the tax office sort of chiming in with their ruling, because they can see this legislation ain't coming anytime soon. So it will come, if it does actually ever get across the line, it would take effect from the following 1 July. So 1 July 2024 is not far away. No legislation even tabled, so it's not going to happen this year. Theoretically, if we saw some enabling legislation happening and some argument about it, and it started fairly soon into the new tax year, maybe it could happen by 1 July 2025 at the earliest. But at the rate of progress to date, like 3 years since the original announcement, this could take some time. I think it's better for it to take some time and for them to get it right than to muck it all up and cause a lot of problems. But as I was looking at these rules, I was wondering to myself what unintended consequences it might create for the tax office, because years ago they took away the main residence exemption for people that are non-resident. But then if you've got an easy 45-day rule to pass, then there may well be a loophole there that people come back into the country, trigger tax residents, say they don't have a home overseas, tie break themselves into the Australian tax net and say, oh, well, now I'm going to sell my property. So you could actually get around a rule that they're designed to trap expats and get them to pay more tax. They might create a loophole that makes it easier to be tax resident for that transaction. So these are the sort of anomalies that would need to be thought about as the government and as the parliamentary draftsman works through these issues. And they're never easy issues with tax. It's never simple. I've just been through a difficult, complex case for a client who'd taken money out of their Swiss pension. How do the tax rules work? What section applies? Had to actually go and research it to get the nuts and bolts of how it all worked. And so that's when you do need tax advice, probably before you take any money out of Swiss pensions, if you're actually, or any pension from overseas and you're coming back to Australia, that's when you need to get advice. So that's a quick run through, trying to cover a lot of issues there. I think we do have some time, maybe for some questions. I can see Ryan's back online there, so maybe if we can cover off some of the questions that have come through during the presentation.
Yeah, certainly, Jeff. I think one of the questions I seen pop up earlier as you were doing the slides, I was just having a read through, was if someone is spending 60, 70 days back in Australia, but mainly for holiday purposes to see family, how would that work if the new tax rules come in from a tax perspective and residence perspective?
Well, that's right. So under the new rules, if you're an Australian citizen or you've got PR status, that's the first factor. If you come in for 70 days, okay, well, you've passed the 45 days. There's 3 other factors. So if you had accommodation, Australian accommodation, so you went back to the home that you used to live in, but then Australian accommodation could include rental accommodation. So it depends on how that's defined. So if you had something that was permanent, then you could pass that second factor. If you had economic connections, so it depends on how that's defined as well. So the thing is, it could be very easy to trigger tax residence. And so then the question is, well, does that mean I'm now taxed on my worldwide income? Am I in a country that has a double tax treaty, and therefore maybe I can be, tie breaked back out of it? So it doesn't matter that I'm in Australia and tax resident in 2 countries at once, because the tiebreaker will assign rights back to, the country, where the treaty is actually held. But there's only 45 countries with treaties, so there's about 170 countries. So there's obviously a lot of countries where there isn't going to be tiebreaker relief. So if you're coming in from somewhere like Dubai, UAE, or you're coming in from, Middle Eastern countries where there's no tax treaties, or Hong Kong where there's no tax treaty with Australia, So you could suddenly be looking at tax on your worldwide income just because you've had a holiday, an extended holiday in Australia. And so this is clearly what the tax office and what the government is after, is to try and capture those people that are coming in and out. You know, at the moment, if they had a permanent place of abode overseas, they'd be pretty much okay. They could potentially go above 183 days and still not trigger tax residence. But this new rule is basically designed to lock things down much tighter than they have been before.
Yeah, it's the same as the UK changes they made, Jeff, back in 2018, I believe it was, or 2017. They entered into a ties test where if you go above, you know, your 90 days, then it's all dictated based on your economic ties, your assets, where your family lives, where you work. And the reason they're doing that is because we live in a world now where, you know, there'll be people on this call, quite frankly, where you might work for a French company, but you're sitting in the south of Spain, or you might work for an Australian company, but you're sitting in Switzerland. And people have the luxury now of working where they want to work. And if you're lucky enough to have, you know, 3 holiday homes or four investment properties, then you can almost pick and choose where you want to be tax resident. And that's what the UK have clamped down on. It's something that Australia will be bringing in. Did you say it's likely to be the 1st of July 2026, Jeff?
Well, yeah, I think the earliest would be 2025.
Right. Okay.
But we would need to see enabling legislation, and we'd need to see that being debated. And if they're arguing about superannuation now, there'll be a lot of lobbying, and there'll be lobbying probably also from chambers of commerce, which has happened in the past. So I think you're looking at, you know, at the very earliest, I'd say probably a very low probability of 1 July 2025. It's more likely 26 or 27.
Yep.
And I think just to the point on the UK rules is that the UK ties and days, a more complex set of rules, but a much better set of rules, a much more.
Yes.
So yes, you can do the calculation, and I've done this. I've been doing some tax advice with a colleague who's a UK tax expert, and we've been going through the ins and outs of it. And the thing is, if you apply the rules, you know, you've got a more graduated approach, and it seems a more sensible set of rules than just locking it down to 45 days. But probably the Australians don't necessarily, they're not as worldly as, say, the UK and European systems would be, and that how easy it is to be moving from one country to another.
Mm. We had another couple of questions here, Jeff. We'll try and cover 2 more, and then listen, if there's questions we haven't answered, Jeff and I both do initial discovery meetings for no charge. They normally last 30, 45 minutes. So if you want to come on and share a little bit more of your personal information, perhaps we can answer your questions here. But there's a question popped up. Can I open a super whilst being abroad? I guess the answer to that, Jeff, is they cannot open a super, but if you have an existing super, even if it's quite small or dormant, you can contribute back to that, and you can actually move it and manage it as well.
Yeah, so if you've got a tax file number, you can theoretically open a superannuation account. And if you've worked in Australia for any amount of time, you certainly will have a superannuation account because it's a mandatory system. But for people that are not PR or citizens, you know, that can't get a tax file number, well, they can't set up a superannuation account. I've got some cases like that at the moment. They just, until they get a TFN, they're not going to be able to get a superannuation account. But the reality is, what you want to do with your super is make sure it's just in a good fund, but not necessarily be putting into it unless you've got a focus on coming back to Australia and a trajectory through to retirement.
And then there's another question about.
Yeah.
Sorry, Jeff, when you go.
Yeah, so it's really horses for courses. And so the types of cases that Ryan and I would have together, so people in their late 50s that are coming back to Australia in the next few years, they're obviously trying to get set for retirement. They're trying to get as much into super as they can, but they also would focus on the offshore products as well because of the tax advantages. So they actually blend together quite well. For people that are younger in their 30s and 40s, you know, waiting till 60 to get your super is a long time. So you don't necessarily want to be putting a lot of extra super money in at 30 if you're going to have to wait 30 years to touch that money. So arguably, the younger you are, the more attractive it would be to be using some of these offshore type investments, which are much more flexible. you know, in terms of multi-currency and things like that, and a more favourable tax outcome.
Yeah, we'll round off on that, Jeff, actually, because someone flagged up a question saying, what's an offshore bond? Look, I'm just a little conscious of time, but just to highlight what Jeff said there, an offshore bond, it gets given the term offshore bond from Australia, but the reality is the bonds are onshore in Europe. So if you're in Switzerland or Europe, they're onshore in Europe. They tend to be based in, they're effectively investment platforms which operate mainly out of, perhaps Dublin or France or Luxembourg or areas around Switzerland. Now, what these vehicles are is they're just effectively personal investment accounts, but they have a life assured aspect in the event that if the owner of the investment account passes away, 101% of the vehicle's value kicks out to your beneficiary, whether that's a wife, whether that's children, whether that's a friend or other family members. Now, the big thing here is if you had an investment bond in Australia, these accounts are actually taxed each year at the rate of 30% on growth each year, but then they're not taxed on the drawdown aspect. If you open it when you're outside of Australia, they grow tax-free because they're under European rest of the world law. And also, if you hold them for 10 years, they're actually not taxable when you draw down in Australia. Now, that doesn't mean you have to hold them for 10 years outside of Australia. You can go back to Australia with the vehicle. As long as you hold it for 10 years, all of the proceeds after actually are not taxed on drawdown. So you're benefiting from the tax-free accumulation and the tax-free drawdown. Jeff's right. It depends on your age and your position and your strategy. I've got a lot of clients who are in their late 50s where stacking the super is the best thing because it's tax-free from 60. But if you're younger and you're in your 40s or 50s and you don't want to give up the liquidity for the super, you want to be looking more at the personal investments, which provide a wider range of currencies. They provide access to, although it's got the name bond, it's important you know that it's just a platform. You can access stocks, equities, ETF, bonds within it. It's just a platform. So it gives you more flexibility over currency, over investments, and more flexibility over the drawdown. But both these vehicles work hand in hand, and it's something that we help people with a lot, particularly if they're going back to Australia and not staying abroad for retirement. Okay, we're going to round off, everyone. Listen, thank you all for joining. We hope that everyone took some value from today. I know I did, Jeff, even though we do this every year. So thanks again, Jeff, for your time. I know it's late your side. And yes, stay tuned. If you want to follow us on our social media channels on Skybound Wealth, if you want to follow Jeff's page, Magenda, feel free to reach out to us for initial discovery meetings. As I say, we don't charge for those between both of us.